Hello and welcome to this month's Financial Markets Update. Well, January proved to be another solid month for financial market performance. We saw some good returns out of developed market equities, particularly large caps, and that continued on from a very strong fourth quarter. Emerging markets and global small caps were slightly lower over the course of the month, both for different reasons. We really saw some profit taking in global small caps after what has been a strong period, and particularly benefiting from the fact that really, central banks globally are now on hold. Next move will be down. We think that'll be through the second half of the year. So we have seen some rally in the global small cap market. Emerging markets slightly different. The weakness in the Chinese equity market really continued throughout the course of January, and we saw the Shanghai Composite Index down just under 6.5% over the course of the month, and this really impacted the performance of emerging markets. And by and large, it's been a drag on emerging market performance throughout the most part of 2023, particularly the second half. And from our perspective, even though we've maintained a position in emerging markets, we're certainly not adding to that, just given our current view and the backdrop of the economic environment in China at the moment. Interest rate sensitive sectors were by and large flat over the course of the month. Aussie REITs benefited from the fact that the market view now that the RBA is done, so they continue to benefit from that. Global REITs were impacted on two fronts. Firstly, we saw some weakness in the Aussie dollar, so the hedged AUD exposure in global REITs impacted the performance of that part of the market, on top of some weakness that we continue to see in parts of the commercial real estate sector in the US, and again that flowed through in terms of the overall performance of global REIT markets. Bonds were by and large flat. We didn't really see a significant move in bond yields over the course of the month. As I said, we resulted in, really a flat performance for fixed income markets. When we're looking at the inflation story globally, and just looking at the charts here, you can see Australia and the US, but really in the context of why we think central banks are on hold now is that they're probably, in our view, broken the back of inflationary pressures. Doesn't mean that we won't get month-on-month readings that the market may not anticipate, but from our perspective, we think, as I said, a lot of the heavy lifting that central banks have done over the last 12 to 18 months is done. Inflationary pressures continue to moderate, but when we think about what the next move will be and the timing of the next move, from our perspective, when we break down within those inflationary environments, particularly if you're looking, say, at the Australian context between tradable and non-tradable. So think about tradable in the context of goods that we both import and export, non-tradable effectively services, as well as aspects such as utilities, energy and the like that, as I said, you need to cover for. And there is quite a demonstrable difference between the inflationary outlook for both of those, and certainly in non-tradables we've seen that in terms of energy, utility, insurance and the like here domestically continue to remain elevated. So even though we have seen a decline in the Australian inflation rate, now tracking at just under sort of 4.5%, we think it's going to be some time before it moves back into that 2.5 band that the RBA's looking for, given the fact that the tradable side of the CPI basket continues to remain elevated. Doesn't mean that we expect the RBA to increase cash rates any further, but as I said, we don't think they're going to be in a rush to cut either. It's a very similar story in the US when you're looking at the cost of input goods, the cost there versus obviously the service side of the economy, which continues to be the main driver in regards to economic activity. And even though we have seen some decline in both parts, on the goods side it's been more pronounced than what we've seen on the service side of the economy, and one of the reasons why in a strong labour market environment services continue to remain relatively elevated. Again, heading in the right direction. We certainly believe that the Fed is on hold now until really the second half of the year, along with the RBA. But from our perspective, we don't see any major central bank in a rush to cut rates, given the fact that headline inflation continues to remain above target levels. It remains a little sticky, and on that basis alone, we think it really is a second half calendar year story in regards to the move in cash rates on that basis. We're looking at reporting season. We're heading into the domestic reporting season, and we're at the back end of the US reporting season. So, just thought it'd be worthwhile touching on how we've seen that side of things. And from our perspective, one of the reasons why we've seen equity markets move higher throughout the second half of last year, particularly the fourth quarter into January. US reporting season, by and large from our perspective, has been a good one on two fronts. First and foremost, we've really seen some breadth in terms of the performance of individual companies over the course of the reporting season period, and more recently. Throughout 2023, everyone spoke about the Magnificent Seven and the impact that they had in terms of the S&P 500 performance. But you can see here from the chart on the left that we've really seen a broadening and an increased breadth of the performance of companies that have been trading above their 200-day moving average. And this is really translated, as I said, into, in our view, a broader recovery in regards to equity market performance, and unsurprising in the context of the strength that we've seen the S&P 500, particularly over the last 3 to 6 months, and as I said, throughout the course of this month, reach an all-new-time high. But more importantly, when we're thinking about what's driving that, and ultimately it really needs to be earnings. And you can see the chart on the right just highlighting the shift in earnings growth from the lows coming out of COVID and the lockdowns. You can really see that the economic recovery in the US has been real, and this has really been translated into increased and improving earnings, corporate earnings, really on a quarter-by-quarter basis since the low point in the early part of 2022. So from our perspective, when we look at that and translate that into the performance of financial markets, it makes a lot of sense that we are seeing stronger earnings, we're seeing a stronger economic recovery, and as I said, is ultimately translating into better equity market performance. We think that can be maintained, probably not at the same rate that we've seen over the last 12 to 18 months, just given the impact that we think that higher cash rates will deliver into the economy, and ultimately we think the US economy will start to slow along with the global economy. We're not sort of predicting a recession by any stretch of the imagination. As I said, we do expect the cash rates will move lower throughout the course of 2024, but in the context of where we sit today, said some very strong equity market performance. We might see a period of consolidation, but notwithstanding that, as I said, we still remain, as I said, of the view that equity markets can continue to push higher from here. However, it hasn't all been roses, and really just one aspect of the market that we continue to remain focused on. We've really seen the impact of that when we think about Chinese property market is US commercial real estate, particularly on the debt side. And you can see here from these two charts that US commercial real estate has certainly struggled over the last 12 to 18 months, unsurprisingly, given increased work from home. We've clearly seen the impact that higher cash rates have had on capital values, and we've seen cap rates continue to move out, particularly through the second half of last year, and that has really impacted transaction volume as well as obviously the asset values themselves. So from our perspective, this is one aspect that we're certainly beginning to increase our focus on, just given the fact that we've seen this play out through the early part of last year with Signature Bank and the like. We certainly believe that the US commercial real estate market has had some challenges and is likely to continue to have some challenges as we head into the first part of calendar year 2024. And the chart on the right just is highlighting that the exposure that a lot of the second tier banks have to commercial real estate. This really isn't a story so much about the major banks such as JP Morgan, Morgan Stanley and the like. This is really about sort of those mid-tier regional banks and their exposure, as said, to commercial real estate loans. And so just given that we've seen a significant increase over the last 15 to 20 years and the pressures that we're seeing in the commercial real estate market, in our view, as I said, warrants just to be a little bit cautious when we're thinking about exposures into real estate more broadly, but also what the knock-on impact of some of that could be in terms of the broader market. And as I said, just looking at the Chinese property market as an example with the collapse of Evergrande, Country Garden and the like, we've already started to see how that has impacted overall economic activity in China as well as the performance of equity markets and other asset classes. So thinking about that within the US context, it's certainly not as significant in regards to the overall market, which is clearly a positive, but it is something from our perspective just worth keeping an eye on. And as I said, just tempering some of the enthusiasm that we have in terms of really starting to add additional exposure, both in terms of REITs as well as obviously other growth assets. And it's not unsurprising from our perspective when we look at the performance of G-REITs more recently, as I said, when you've sort of got these overhang, the impact that it can have in terms of overall market performance. Notwithstanding that, as I said, January was another really solid month for financial markets more broadly. And from our perspective, we sit here today, we've continued to refine some of our asset allocation position. We've been happy to increase some exposure to the more cyclical parts of the market with a view that throughout the course of this year, we think cash rates will move lower. Economic activity will remain robust, albeit some level of slowdown from what we've seen through the second half of this 2023. But by and large, we think that'll be positive for both growth assets as well as interest rate sensitive sectors over the course of this year. But from our perspective, a good start to calendar year 2024. We certainly believe, just given the earnings backdrop, heading to reporting season here, as will drive a lot of what we expect to see throughout the rest of this quarter into the first half of next year as well. As always, if you have any queries regarding the portfolios, please feel free to reach out to anyone on the team, and we'll catch up again next month. Thanks, and bye for now.